Hello and welcome to our interview series where we bring you valuable insights from top fund managers across leading AMCs. Joining me and my colleague Chirag today is Mayur Patel. He's fund manager, listed equity at 361 Asset. Welcome, Mayur.
Hi, thanks Ruchira and Chirag for the opportunity. Very good afternoon.
Good to have you here. Let's begin with the first question. What really sparked your interest in financial markets?
Back in 2005, during my time at Tata Motors Jamshedpur plant, I presented a financial analysis to the finance head there. And while reviewing my work, he encouraged me to think like an equity research analyst. And I was a bit surprised, what is this equity research analyst? And, focus more on capital allocation and the potential return on capital allocation while evaluating projects. So that's what sparked my curiosity, and later I enrolled into the CFA course, started tracking capital markets closely and got into an equity research role and eventually into fund management. So that moment laid the foundation for my career in investing.
So Mayur, you have worked with Crisil, Spark Capital, and DSV BlackRock before joining 361. How has those experience shaped your approach to the fund management at the current organization?
Chirag, from my early days as a research analyst, I was naturally inclined toward businesses having very strong return on capital and witnessing very large growth opportunities while trying to seek some comfort on valuation. But after seeing multiple cycles, including cycles of sharp drawdowns when expensive growth stocks take most of the beating, I became more and more convinced about the importance of having a good mix of growth ideas and also value ideas in the portfolio to attempt to have more consistency in performance over a long period of time. So what truly matters to me is to develop conviction, and it comes from depth of research. And one can have very high conviction in a growth idea and also in a value idea. So just to put it in simple words, my style has evolved to be defined as conviction driven bottom up investing across growth and value segments.
All right, now, Mayur, we would like to understand your investment philosophy in detail. And so how do you go about picking stocks? What are the kind of stocks that would never be a part of your portfolio? And when do you exit stocks? So if you could elaborate on this.
Sure. So, Ruchira, as I mentioned, my approach is a blend approach to have a good balance between growth and value. So you can focus all your energy toward identifying bottom up high conviction ideas. So this style is fully aligned to our firm's philosophy of having a good balance of growth, value, and having some defensives. Our SCDV framework, which is secular, cyclical, defensives, and value traps, that framework guides our portfolio construction. So the secular growth forms a core part of the portfolio, while value traps are the least preferred. And then in between, you have value cyclicals and defensives, which are more of high quality. And we adjust our allocation between these two segments based on our view on the economy and also on valuations. So, you're very clear in your mind what's your long-term portfolio, irrespective of the changes in the economic environment, and where you need to optimize in terms of managing risk better and optimizing performance in the medium term. So this structured approach helps us to achieve a very good amount of diversification, even in a concentrated scheme. In terms of adding on to this, there are some core principles close to my heart. I try to avoid investing in narrative-driven stories, even if these are in high momentum. But when you can't justify valuations based on fundamentals. So, these are some of the bubble areas which I try to avoid. I try to develop more conviction, by getting the touch and feel of the business. And last but not the least, when you're in doubt, focus on cash flows. When you're evaluating the quality of a company, the track record of cash flow generation over a long period speaks a lot. And how these cash flows have been deployed is very, very important. So these are some of the principles, very close to my heart in terms of when it comes to investing.
Mayur, we would like to understand a little bit in deeper, because this is the first time we are talking to you, and the funds are doing very well. So just we wanted to understand the proper, how do you buy the stock in the portfolio? You spoke about the framework. Could you elaborate a little bit on the framework? Means what's it, and how do you go about selecting the stock sectors? What are the number of stocks in the universe and there about it?
Sure. So we have around 500 stocks under our research universe, where we have very in-depth research done by our team of research analysts. We have 8 research analysts tracking most of the core sectors. We have a very strong technology system in place, which is a digital research system where the entire research, meeting notes, everything is there on the cloud. And now we have integrated artificial intelligence also, to help us reduce the time consumed in data crunching and some of the mundane work. So these are some of the aspects of our processes. But there are two things. You asked a question which would have 2 parts in terms of when I'm answering. The first is a top-down, where this framework comes into place, that what part of the portfolio has to be in growth, what should be in value, especially cyclicals, and what should be in quality. And that's a call taken based on a view on the economy, on the valuations and things like that. But that's more top-down. But the real work happens at the bottom-up level, and that's where you try to develop conviction at the stock level. So we have very strong processes around financial analysis, forensic analysis, fraud detection tools like Benford's Law. All of these tools are automated. So when any new idea comes, for discussion, before spending even 2, 3, 4, 5 days or even more in terms of research, we go through our system and check for the hygiene in terms of governance, forensics, and fraud detection tools like Benford's Law. And if we see any red flags, we don't even spend a minute. So in 5 minutes time, we get a clearance with respect to the basic hygiene governance for a new idea. So that's very important tool in terms of proceeding on any new idea. And everything else, so we have a basic threshold of quality, even if you're buying a value name or a growth name. And then it involves a standard process of financial analysis, valuation analysis, meeting the management, visiting, the hard assets of the company, getting the touch and feel of the business, developing that conviction. And then at the end, you try to see how is this a growth idea, a value idea, given your SCDV thoughts, whether it fits into the portfolio construction or not. So that's a, very, I would say, a short answer. If I can get in, I can spend an hour describing our process, our technology, our digital research system, and everything else. But this is a shorter version of that.
No, we don't want our mirror, but at least some few moments basically on the if suppose investors want to understand how does Mayur Patel chooses a stock in the portfolio. You spoke about it at a broad level, but what are the key reasons? If suppose markets are high today, would you prefer growth or value? So that kind of thing. Just wanted to understand on that minor details.
So the investment framework or the research framework, or in simple terms, the mindset to invest in a growth stock is slightly different to invest in a value stock, right? Value stock, in terms of when it comes to value, you try to take a slightly contrarian view, some of the good quality businesses which are out of flavor, and you try to see the basic cash flows gives you a hard valuation. And if the stock is trading at a good discount to that, it becomes a good bargain. The filter is the good quality. So it's a good quality company having strong track record of cash flow, going through a rough patch in terms of growth. So you are very convinced on governance, very convinced on management quality, and quite a few other things. And you are willing to take a contrarian view on the near term to medium term growth factor, right? And that's where you try to find out, value names. In the past, we had few value names in the public sector, which are very cheap with very strong cash flow, very high dividend yields, and growth was likely to come back because of the government policies and things like that. So that's one example of value. Similarly, we had a telecom name. We still own it. It was a proxy telecom. One of the vendors of telecom operators, and given the uncertainty around one large OEM's, the survival factor of that OEM, the stock was trading at a large discount to the intrinsic value. And even if we did that analysis, that even if we write off the cash flows coming in from one client, which has a risk of shutting shop, still it's trading at a large discount. So when it comes to value, you have to think in terms of what is the value of cash flows valued conservatively, pricing in the worst case, and if you're still getting a large discount to it, it makes sense. When it comes to the growth stock, say electronics manufacturing is a very high growth area, or quick commerce is another high growth area. Other parts of manufacturing is also a long-term growth story, right? So where you are seeing opportunity widening, and the industry size itself can go by 4 to 5x in 5 years' time, right? And then you cannot be very, very fixated to the short-term valuation parameters. The price to, if you look at price to earnings based on the current earnings, or the, say, of near-term 1 year forward earnings, it would always look very expensive. So here the conviction has to come from, one, how big is the opportunity over a slightly longer term? Number two is the management's capability to execute. And you're betting on this management. Can this management stand and deliver given the large opportunity? Obviously, the quality and other things are hygiene, but then you're taking, bigger weightage is given to the growth prospects, and valuation is more like a hygiene, that you are not paying something obnoxious. You're not paying something which, you cannot justify even 5 years out and things like that. If it is slightly expensive, purely from a near-term point of view, you can still, work with it if you're very, very convinced on the 3 to 5 year growth journey. So that's, some thoughts I'm having, we are deploying while investing in growth names and in value names.
So, Mayur, what is the minimum market cap threshold for a small cap stock to appear in your radar?
We don't have any such thing coded, but normally I've seen we've never gone below few thousand crores market cap.
So, Mayur, you spoke about the methodology and the stocks which comes into portfolio, but what are the points, or how do you exit a particular stock?
No, so it's very clear. Either so I've say recently we bought some renewables name and some other high growth name, and what we thought that our 5 year thesis will on high growth will pan out, and the stock should give us X amount of upside over 2 to 3 years time. And in the previous calendar year, when small and mid caps were rallying wildly, I would say, some of these upsides came in 3 months time, 4 months time. So then you clearly, put your heads down, do a very sensible analysis, not getting swayed away by the momentum, and see that your thesis is fully priced in or more than priced in, and you don't see upside even factoring in 5 years ahead, then you take money off the table. On the other side, if the company is underperforming consistently, we give some time, but if we see our investment thesis is getting derailed and we don't have enough conviction that it will come back, then even if you're slightly out of the money, we'll take the chips off the table.
What kind of stocks are never part of your portfolio? and what are the reasons for that? Is there any particular thing which you don't touch absolutely? It's a no-go for you?
No, so the basic quality threshold is the only factor. Otherwise, we don't have any such blacklist or any such sectors which we would never touch. But we don't want to get into something where we have grave concerns around governance. So that's and we have enough tools to evaluate, the governance and the quality factor.
Coming to the some sector allocation, how do you approach sector allocations, and what role does the benchmark plays in such situations?
No, so most of our products are really bottom up, and we don't do benchmark hugging at all. And it's a clearly bottom up. So again, when I say bottom up, there would always be the sector call is a summation of what ideas you are getting at the bottom. And if you are negative, say FMCG, we had a large underweight for quite a few years. So we always thought that valuations are very expensive, while for that expensive valuation, you're not getting high growth. So despite having a decent weight in the benchmark, we had very little exposure in the portfolio. So that way, we don't hug the benchmark. We don't shy away from taking large bets, even in a mid-cap space, if the conviction is very high. Even in a non-benchmark stock. So it's purely bottom-up, Chirag. It's a function of our process, philosophy, and at the end, it should fit into our SCDV framework given our top-down thoughts.
So do momentum indicators play a role in your portfolio construction?
Not at all. So in my funds, it's 100% fundamental driven factors. Momentum is not an important factor to consider.
Maybe sometimes it worries you because we saw momentum being in the market for the last 2 years or kind of thing, and at that point of time the fund might underperform. So does it worry you sometimes, or is it fine? It's part of the game.
So Chirag, don't get me wrong. I don't take a deliberate non-momentum approach, right? We have our fundamental framework in place to identify ideas in growth and value and have that mix. And if you're getting your ideas right, it will definitely come into momentum at different points of time. So we have a system which always shows that what percentage of your portfolio is into momentum at what point of time. So you'd always have some percentage of your portfolio in momentum, some percentage of your portfolio outside momentum, and things like that. So it's not looking at momentum and investing, or neither you are trying to take an anti-momentum call. You are sticking to your basic fundamental analysis, and that should help in terms of getting some stocks in the momentum at all point of time.
Another thing for me was just to understand the cash calls. Do you take any cash calls depending upon the market conditions?
No, so as a philosophy, we don't take huge cash calls whenever we get inflows and redemptions. So 2 to 5% is the typical range which we keep. There could be some temporary cash can go up a bit, maybe up to 8, 9, 10%. Given that you have sold something in a volatile market, you're taking your own sweet time to deploy it and things like that. But there's no deliberate cash call to have 20%, 25% in the portfolio, even if you are cautious on the market.
Now coming to the markets, how do you see the current market environment, and do you think the volatility will continue in the near term?
See, we have seen massive FII outflows recently, around $8.5 billion in January, followed by another $2.5 billion in February. And starting from September, this has been going on from the September peak. This is driven by a broad-based sell-off across emerging markets and hardening of US Treasury yield and stronger dollar are the key factors behind it. So these global factors, followed by our market valuation was at a significant premium to our median. It went to 4.25 price to book versus 3.2 is the 25-year median. So the valuation was very high, and our growth slowed down to 5.2, 5.4% GDP growth. It could be transitory, but it's a function of these factors, which has caused this correction. And in the near term, until we get more clarity on the US trade policy, I think the volatility would continue.
And what factors could drive a recovery in the Indian equities over the next few months?
Number one, clarity on US trade policy. So currently, global factors are driving, having more influence on our market. Number two is your pickup in GDP growth. We have seen a very strong boost, from the tax relief announcements coming in our budget. That should reflect into pickup in consumer discretionary demand going forward. So that's very important. And government capex, though the budgeted numbers are flattish from the trajectory point of view, but we saw a sharp dip in the previous calendar year. So some part of the tendering activity should come back. So these are some of the catalysts which are important for the market in the near term.
Mayur, with markets correcting by 15% or so, do you believe that the valuations have become some more attractive, or are there pockets of exuberance even now?
So we believe price to book is the most important and reliable valuation parameter. If you see in September, our broad market, if you look at our broad market, the Sensex price to book went up to 4.25 in September. And after this correction, it has come down to 3.76. So the 25-year median is around 3.2, 3.3, somewhere in that region. So 4.25 was a massive premium to price to book. And always we see that 2 to 4 times is a band, and above 4 times it becomes really expensive. So we've seen that premium coming down a lot. Still, there is some premium left, but the risk reward is improving in the broader market. But small and mid caps, if you do the same analysis, still the premium is very high on price to book basis versus the history. So that way, and there are pockets of exuberance left still in the small and mid cap space. So while this correction is throwing up a lot of interesting small and mid cap ideas, which are good quality coming up at reasonable valuation now, but there are still other pockets of exuberance in that small and mid cap space. So the view is more positive on the large caps, very selective on the small and mid caps, and would love to add some of the beaten down small and mid caps where risk reward is interesting, but not painting the brush broad-based across small and mid caps as of now.
Right now, coming to a few fund-specific questions. In a very short span of time, the 361 Flexi Cap Fund, it has done quite well. So can you share with us what are the key reasons for its outperformance?
Oh, it's too early to celebrate. So the fund is about to complete 2 years in this June. So it's too young, I would say, from the vintage point of view. Yes, we had a great start for this fund, and it's driven by purely bottom-up approach. It's a flexi cap fund, so we have promised to investors that we'll stick to truly to the label. So it's truly flexi cap in nature without any market cap bias. So bottom-up approach has helped, and implementing our investment philosophy with full discipline, has also helped, and not getting swayed away into bubble areas. In terms of sectors, some of our small and mid caps in electronics manufacturing, in industrials, in pharma, CDMO has worked really well, and that's what has helped the performance in the first leg. But I would strongly recommend when you are evaluating the performance of any scheme to start with at least 3 years and give more weightage to 5 and 10 years performance.
Right. Now, coming to your focus strategy, which has demonstrated consistent performance compared to both the benchmark and peers. So what's the key to this consistency?
Our focus fund is our flagship fund, which completed 10 years recently with top quartile performance. You can refer to our fact sheets for any other details. And it is a journey of following a disciplined approach of investing in a balanced way across these 4 quadrants of our framework, which I explained, and having a very bottom-up approach. At times, we have very high conviction on a mid cap, on both valuation side and also on the fundamental side. We have not shied away from having that as a top 5 ideas also. Whereas at times, top 10 ideas are all large cap. So it has been really, I would say, flexible in terms of investing, very disciplined approach in terms of investing in all the 4 quadrants of our framework, sticking to our forensic tools to reduce mistakes. We would also have always, committed small mistakes, and we'll also have winners and losers in the portfolio. But the idea is to reduce mistakes and try to focus on more risk-adjusted returns. So like 2024 was a soft year for us. As compared to a 10-year trajectory, the performance was closer to the benchmark. Very little or no alpha, I would say, which is not the ideal outcome. And the reason was we became cautious in small and mid caps a bit early in the year, and the rally in the tail end of the market continued. At the same time, there were some 3-4 large active bets which didn't perform in line with the very strong rally which was there in the tail end of the market. But our conviction is very, very high on these active bets which didn't work out. But our disciplined approach is again helping us in this correction period. So that's there's no such magical formula. It's just stick to the basics. Try to follow your investment philosophy. So we always say that having a good investment philosophy is only one thing, and implementing that consistently over a long period of time is what is very critical.
Maybe you rightly spoke about 224, it's being the returns being in line with the benchmarks. But even in 2022, there was a slight blip. So what was the reason for this 2022 and 24? Was it the same reason or was it slightly different?
No, so 2022 was a modest year, and our performance was slightly below benchmark in that year. But from the portfolio point of view, I had no discomfort. It is just a natural course. Sometimes what happens in a long journey, because if you look at our portfolio turnover, is one of the lowest in the industry. So we don't get into churning portfolios to optimize 3 months, 6 months performance because we're looking at more long term. We want to create performance over a long periods of time, and hence at times you will find bunch of your active bets suddenly gets into consolidation. There will be periods like that. As far as you are very convinced on as far as you're very convinced on your portfolio positioning from a long-term point of view and not worried about the short-term volatility, it's fine. So that was one of the same kind of years. I don't think so we had any major blunders in the portfolio.
Mayur, after the recent correction, which sectors or themes do you find attractive and which are still overvalued?
Looking ahead, we do expect some shifts in market trends. So the growth leadership is shifting from government capex to consumer discretionary, in my view. So if you look at 2019 to 2000 till the last year, the government budgeted capex has grown from 3 trillion to 11 trillion. That's a massive growth, right? But currently it's flattish. And given the government's priority towards controlling fiscal deficit and also reviving consumption, which was very clear in this budget, you will not see a massive growth on the central government's capex. So there will be one shift in the trend where discretionary consumption has been muted for last 4 or 5 years, can come back because of these tax relief related boost, and followed up by pay commission related hikes next year. So that's one shift in the market, growth leadership, which I'm thinking. And the second part is after outperforming for 3 to 4 years, value can take a back seat, and quality and growth can come back in favor. So pickup in consumption, rate cuts, liquidity improvement are all factors which can create a good premise for quality and growth to come back. So we have been shifting some weights from value to growth and quality over the last 6 months' time. In terms of sectors, there are quite a few growth themes and growth sectors where I'm very bullish. Number one is manufacturing. I'm extremely bullish on the manufacturing story in the country, which includes renewables manufacturing, it includes electronics manufacturing, and quite a few other sectors. Then you have auto EV plays, which have taken a breather in the recent past, but that's another high growth sector. Then we have pharma CDMO is a very strong secular sector. We should witness very strong growth over next 3 to 5 years time. Quick commerce is emerging as a very strong growth area. We should see exponential growth in quick commerce sector. Large quality NBFCs having large, strong franchises on the retail side are in a sweet spot for a high growth in the near to medium term. In terms of when we look at the value side, private banks and telecom are the two sectors which we like in the value bucket. So overall, we are positive on more inward-looking domestic stories rather than those overly reliant on global factors.
And any on negative on any sectors?
We have an underweight on FMCG, where the pickup in consumption, I think the discretionary part of the consumption will get a stronger boost than the FMCG part. We have an underweight on energy, and yeah, these are the two main areas of.
All right, now one last question before we wrap up. So, if you had to share one key opportunity or risk that investors should keep an eye on in the Indian equity market, what would that be?
Clearly, manufacturing is the biggest opportunity in the country over next. Actually, it's a story for the next decade. So that's clearly the largest opportunity in our country. In terms of risk, what comes to my mind is in the near term are these global factors. So you need to keep a close watch on the US trade policy, how tariffs are going to unfold, because that's going to impact positively or negatively our exports. And from the other macroeconomic factors, the crude price is always a key monitorable from the risk point of view. If crude price is at $120, our entire economics will go for a toss, right? From current account, deficit, fiscal, currency, inflation, everything gets distorted. So crude price is another risk factor to keep a watch. As of now, it's in a benign zone, but it's something to monitor.
Well, then it's time for us to wrap up this chat. Thank you, Mayur, for taking the time for this interaction. It was lovely speaking to you.
Thank you so much. Have a good day.
Thank you.